Hello and welcome to the Monday Futures Market Outlook for May 7th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eMoneySource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and particularly we now are seeing a reversal here with some strength in the U.S. dollar, particularly against the euro currency. And really, at this stage, that U.S. dollar is at a key pivotal level where it's now reached its April highs. And if the U.S. dollar can strengthen through these levels on the upside, it would certainly open the window for it to retest the highs of the year, which occurred in that 81.50 to 82 area. In the bigger picture, we remain optimistic for a bullish U.S. dollar into the second half of the year, but we remain relatively neutral until we actually see some follow through to indicate that the U.S. dollar is beginning a new trend. When we take a look at that euro futures contract, you can see how the euro has weakened down towards the 130 level on the outcome of the French elections. This is a crucial level. Again, we're at the edge of that cliff. Really, at this, we've seen these like head and shoulder style formation topping patterns over the last couple months. And really, if we see any price action consolidate below 130 on the downside, it really could open that window for a sell-off, not only down to that 126 level, but there are even a number of scenarios where we can measure it out even down to the 122 or lower. Now, that, again, those would not be short-term targets. That would be much bigger picture, but it all starts below 130. So this is really a make it or break it moment. Let's see if the euro bulls can quickly put this back out of the danger zone and get it, let's say, back up to 131, 132 to neutralize it. But any aggressive selling that follows through on today's gap lower, that would certainly open the window for a substantial decline in the euro and subsequently strengthen the U.S. dollar. Next year, we would want to take a look at the 30-year Treasury bond, and while the 10-year Treasuries have already broken to higher highs, the 30-year Treasury bonds are just coming back towards their highs that they put in that period from November to February. Really, at this stage, we remain relatively, at least initially, neutral on bonds. We do believe that there is room for bonds to surprise everyone with another leg higher, but we don't necessarily believe it starts off this level. We could probably somewhere off these levels here see the 30-year Treasury bonds hit some sort of a high and even do a little bit of a retracement lower before a really good buying opportunity may emerge. Next year, we're going to take a look at copper prices, and copper we were suggesting could find some substantial overhead resistance at that $3.90 to $4 area, but we never made it even up that high. The 385 level very quickly last week rejected the prices of copper and caused them to trade all the way back down towards their lows that they put in last month in April at the 360, 365 level. In the bigger picture, we are actually bearish copper and commodities in general, and believe that with a strong U.S. dollar environment, we could see all of the price of these commodities move substantially lower on the short term. And we're going to now get a critical piece of information on copper, because if we see follow through selling on copper that has it retest that 360 level on the downside, any substantial break to a lower low really could put copper into a full sell mode. Now, again, we're not in sell mode yet, so we're just going to see whether or not the sellers can follow through on this to actually give that signal. When we take a look at crude oil, even though copper hasn't made the break, crude oil certainly has. We suggested that in order to, in the bigger picture, leave the window open for crude oil to strengthen back to its previous highs, we needed the price to hold above that 101 to 103 level. With some very strong conviction, we saw almost $10 wiped out on oil in just a few days. This really has changed the sentiment toward oil very quickly. Not only has the trend of higher highs and higher lows ended, but really this changed the landscape very quickly. Now, while that doesn't necessarily mean the next few days will have to be substantial new selling in crude oil, we certainly will see that if crude oil fails to have any follow through, especially if it cannot even make it back up to the 101 to 103 level to retest that zone, things could quickly turn to further new selling. That we could even set targets down at $90 or lower on crude oil in that bigger picture. Again, this could take a month or more, so it doesn't necessarily mean that the next few days have to be aggressive selling in oil. But really, at this stage, unless the crude oil bulls really get this back above that 101, 103 level quickly, then a new downtrend may very well have begun here on crude. Next year, I want to take a look at gold futures, and gold has not made the breakdown move, but it hasn't been strong either. We continue to see a wedging formation that continues to hold that 1630 area, which we've been talking about lies the pivot from which gold can be bullish or have a breakdown move to test previous lows. And surprisingly, gold has really held in here in spite of everything we're seeing in so many other commodities. Really, at this stage, we want to remain more neutral on gold than others, but certainly, if there's any legitimate breakdown to lower lows on gold, we would accept a bearish trend that could see gold retest that 1540 level down below. But at the same regard, if there is no breakdown move below this 1630 area marked by that blue box, there's always the chance that gold could actually move higher as a hedge or risk management asset, where money may go to if the whole market starts to weaken. So we're far more neutral on gold is the bottom line. So when we finally take a look at that S&P 500, looking at the weekly charts, you can see here when we put an 80-week moving average on there, it depicts the bull and bear market cycles that we've gone through, recognizing that really at this stage we are distinctly above the 80-week moving average. And even though we are talking about scenarios where the stock market can weaken, it is far from giving a bigger picture bear signal on the downside. And really at this stage, even if the market here had a good sell-off of another 60 S&P points down towards, let's say, the 1280, 1290 level, that would simply be a fib retracement that could actually potentially still be bullishly bought. It would, in order for us to be a little bit more bearish, we would need to see a substantial drop in this market that weakens below those retracement zones around that 1280 area. And so in the bigger picture, there's very little reason to change our the outlook that the market is in a bullish trend, but simply just on the daily charts is in a bearish move. So when we take a look at those daily charts on the S&P 500, you can see the double top that has come in. We've now dropped that focal point down to the 1400 to 1420 area, as now that marks both highs that have come in. And there, like we've suggested in our bigger picture forecast, that we could have seen 1450 on the upside. Really, at this stage, there's no denying that there's seasonality in work, in combination with the fact that we've now have substantial overhead resistance. While there certainly is room for a bounce off of this bearish open that has come from the European markets, really we do see the window open for the S&P to weaken down to some lower support lines in the subsequent weeks. We don't necessarily believe that this has to turn into a market crash, but at the same time, after such a substantial rally for well over 6 months, the market is now long overdue for a good consolidation and reset of pricing. And so really at this stage, if the break here to lower lows from that 1350 area starts that selling, we could still see even 40, 50, 60 S&P points in the upcoming weeks before the S&P finds some short-term lows. Just to kind of make a summary of our key intermarket observation, while we are long-term bullish to U.S. dollar, we still remain short-term neutral. There still hasn't been an official breakdown of the euro nor a breakout on the upside of the US dollar, but we are coming to some crucial levels which could change that. Now, we've changed our short-term stance on commodities to bearish, and I understand that this could be very preliminary, because if the US dollar doesn't turn bullish, then commodities can neutralize here. But really, because of that change in sentiment on that crude oil, really was enough to kind of change our short-term bias, particularly with things like wheat and other things breaking down, and copper reversing. There could be some overall bearishness coming in there. Recognize that gold may not necessarily have to follow suit with other commodities, but really this signal that had us change it is really the crude oil move. On bonds, again, we are actually longer term bullish bonds, but we're a little cautious about turning optimistic bonds immediately here. But as we go into the second half of the year, at some point we would look to be going and turning even short-term bullish on those bonds. With the stock market having retested the highs and putting in a double top, we have changed our short-term stance to bearish. But in the longer term, bigger picture, we see very little reason to be bearish. We don't believe that this necessarily has to mark the beginning of a new bear market, and we have very little evidence of that, other than that we know that a short-term top is in place, and so we will remain long-term neutral, but short-term bearish in terms of the fact that the stock market really doesn't have that much upside here. That was your Monday Futures Market Outlook. Thank you for joining me.